Okay, I'll just check that you guys can hear all right. How's sound for up there? Is that all right? It's okay? What about you guys? You're okay? You want a bit more? Okay. How's that? Is that better? That's good? You guys okay? All right. I suppose you guys are not all right. Oh. Where is everybody today? There's a test on Wednesday. Actually, there's supposed to be 170 people in this class. I think 171. You know, yeah, the few bodies missing. Right, we'll just let that clock click over. There it goes. Yeah. Okay, so I'll make a start. So, first thing up is the online quiz that's going to be next week. So the details around that are, it will open at 6 a.m. on Tuesday morning, and it will remain open until 1 minute to midnight on Friday. So that's the open period. The material covered in that quiz basically runs from the overview through to the end of the last topic, which was the regulation of financial institutions. So that's the range of material covered in it. There will be 50 questions, and the way that it's structured as before, they're multi-choice questions, but there will be 2 pages of 25 each, so make sure you do both pages when you do them. There are time allowed for that is 75 minutes, an hour and a quarter, for those 50 questions. And at the end of that time, there's this 10-minute period, which they call the grace period, in which you can review what you have done, but you cannot answer any more questions. And then to get the quiz marked and receive credit for it, you do have to click on the submit button like you hopefully have done every other time. Again, you can have 2 attempts if you want, but there is this required two-day gap between the first and second. So if you want to do it twice, make sure that you do it early enough in the piece, in the period, that you can have your 2-day gap and have a full 75 minutes to complete it before the time runs out at the end. And if you do it twice, then the higher of the 2 scores for that test will be the score that goes into the grade book, and that quiz is worth 5% of the final grade. So is there any question on that before we move to commercial banking? Yep. You have 2 questions. We'll take you first.
What were the total of all the quizzes worth?
They were worth 20 if you did all 5 of them. They were worth 2, 3, 4, 5, and 6%. That's what they were worth.
And what was the test worth?
The test was worth 30,
Oh, yeah.
and the final was worth 50. And the spreadsheet calculates a second way, 100% on the final exam, and it doesn't matter which is the higher, it automatically chooses the higher of those 2 scores as your final grade. Okay. Do you have another question?
I've noticed that on the Learn grade book, they have some practice on each chapter.
Yes, they do.
Does it take into account? Or?
No, that is basically for you to practice with. I mean, every time you create something like this, throws it in the grade book. But when I select the material from the grade book to then go calculate the final grade, those practice tests are not included in the information I extract from the grade book. Okay, any other questions? Okay, so today we're going to start commercial banking. Now, commercial banking is one of our biggest topics. It usually takes 5 lectures, so there'll be today and all of next week to get through it. And the slides are sufficiently long that I split them into 2 pieces on Learn for you. Now, commercial banks within the financial sector are probably one of the most visible financial institutions we have. There will be very few people that don't have 1 or more accounts at a commercial bank. And so pretty much everybody and every business uses commercial banks as part of their day-to-day either life or business. So this is the outline of where this part of it is going to go. We'll have some introduction to these things. And then we'll talk about bank balance sheets. And we did actually talk about them a little bit in the last section. We're particularly talking about the bank capital. Then we'll talk about the use of the funds, the pricing of both the loans and the deposits. We'll talk about off-balance sheet banking, which again, we talked about a little bit from a regulator's point of view in the previous topic. Then look at the effect of the changes in interest rates, because interest rates do move almost on a daily basis, and that affects the value of their balance sheet. And then some other sources of bank income. So, introduction. When we look at both the Australian and New Zealand banking industries, they're structured in pretty similar ways. There's a few large banks. In both cases, the number of large banks is 4. And typically, like in Australia, they say about 87% of banking assets are in the 4 banks. Here, it's a little bit larger, tends to be about 90%, as in the four big banks. Although it's fair to say that there are some New Zealand-owned banks, and they are growing, and they tend to be pulling business in terms of total percentage of the assets away from them. So you might ask, well, how big are these? When we say big, how big are they? Well, these are the numbers hot off the press for the Australian banks. There's your 4 largest banks there, and as you can see, they are heading up towards being $1 trillion banks. The one that's closest is the Commonwealth Bank at $933 billion. It'd probably only be a year or so before that's $1 trillion bank. And those other 3, the ANZ, Westpac, and NAB, it probably won't be too far, in terms of time behind the Commonwealth Bank, then they too will reach $1 trillion size banks. So they are, even by world standards, very large banks. And of course, those 4 are the 4 that own our 4 major banks. So actually, this is I went and checked again. This is now 24. It does change from time to time. We've got 24 registered banks, and the majority of them are foreign-owned. I did look through the list again this morning, and there are actually only 4 banks in New Zealand that are actually New Zealand-owned. All the rest are owned by overseas interests, and the 4 largest of our banks, the ASB, ANZ National, the BNZ, the Westpac, and they are owned by those 4 big Australian banks. So our banking sector is, clearly dominated by the foreign banks. Now, the banking sector itself, plays a key role in the growth of our economy and its prosperity. And basically, if you, as a business, are unable to access capital markets, through the issues of either shares, bonds, or money market securities, then typically the next place you go for funding is to go to a bank. And so there's many businesses, particularly in the small and medium-sized businesses, that simply cannot access the direct financial markets. And most individuals cannot access direct financial markets, although that's starting to change with some technological changes. And so these types of both businesses and individuals, they go to a bank to obtain funding. And so the working of the banks is critical to the running of an economy. Now, this point here about their strict regulatory regime, this is something that's occurred in hindsight in one sense, because, while most people, not everyone of course, most people say that why New Zealand, and as a consequence of it, why Australia went through the financial crisis so well, and New Zealand as a consequence of that. They say it has to do with the strict regulatory regime that they have. At the time, leading into that crisis, there was this complaint from the banks, constant complaint, that they were over-regulated, it was hurting them, and they were being made uncompetitive relative to their leaner and meaner counterparts overseas. Now, of course, the downside to be too lean and too mean is that when a famine comes, you starve and you die. And essentially, that is what has happened to a lot of banks overseas, and why they did not fare well in the crisis is that they didn't have the buffers of capital necessary to absorb the losses that they took. And so, although they grumbled and grumbled and grumbled up into the crisis, coming out of the crisis, the Australian banks became some of the strongest and most profitable banks in the world. And of course, we're a net benefit of that because, our banks here are managed to the satisfaction of the Australian regulators, because our big ones are owned by the Australians. So when we look back in time, we've got comparatively small numbers of banks now. There used to be larger numbers of banks. In fact, I had a slide in a few years ago, which I've taken out, which actually listed all the mergers that had taken place to create the ASB, and there was something like 20 smaller firms of various types of banks, building societies and so on that had been gradually merged over time to become the ASB. So we did have larger numbers in the past, but these have been shrunk down until we've only got a small number at the moment. We've got 24, and I think Australia's only got about 17. In recent years in New Zealand, we've had a few extra banks. There's been a few extra foreign-owned banks actually registered here. And then Kiwi Bank was actually created for political reasons, and it's been a reasonably successful bank so far, and it is growing well. Now, the Australians have this policy, which again is somewhat controversial in some places. They have what they call the four pillars policy, and what that does is stops the four largest banks from merging. So, the ANZ, Commonwealth Bank, National Australia Bank, and Westpac, none of those can merge with any of the others. So that's simply written in the statute, and basically it's there to try to provide robustness and competition within the sector by stopping these really big banks becoming essentially even bigger, and reducing competition, and also concentrating the banks into an even smaller number of very large ones. Okay, any question on that before we move to the balance sheets? Okay, so we're going to start looking at a bank's balance sheets. We did discuss one portion of it in the, actually more than one portion in the previous topic. So at some level of abstraction, a bank balance sheet doesn't really look that different to any other one. There's essentially two pieces to it. There's the assets over there, and then there's the liabilities and capital over here. And one way of looking at those two pieces is that the liability and capital is where do they get the funds from that they need to go about their business, and then the asset side is basically what they do with those funds. So that's pretty much the same structure you see across any corporation. The thing that makes it different from most other ones is the ratio of equity to debt. And typically you'll find that that ratio means that typically more than 90% of the funds obtained for the banking business are debt of one form or another. Now, if you go to any other type of business, typically what they would say if you had this level that was, you're just about out of business. But typically if you're above 40% debt in any other type of business, they tend to think that you're highly leveraged. You borrowed a lot of money if you're above 40% debt out of your total source of funds. And so when you look at this compared to another type of corporation, they are extremely highly leveraged, and that's one of the things that makes them rather fragile. So what we'll do is we'll start looking at one side of this, and then we'll look at the other side, and we'll build up a picture of their... We'll start on the liabilities and the capital, which is your source of funds. So start off here drawing a nice box that will put everything in. So two basic sources. There's the liabilities, and then there's also the capital. And this is basically where the funds come from. So this is your source of funds for the business of being a bank. So when you look at them, the two sides here, there is, if you go this way here on this one here on the assets, basically liquidity goes down. So cash is the most liquid, investments are lower liquidity, loans and leases even lower liquidity again, and other ones tend to be very illiquid. And the same on this side here, your deposits tend to be more liquid, although we'll split them into two pieces. Then the non-deposits, again, we'll split those in two pieces, and then there's your capital. Okay. So where does the bank get its money from to go about its business? Where does it find money? Oh, yes, go ahead. Okay, so one of the big chunks is deposits. So if we start putting where the money comes from, I'll stick the capital up the top. But a big chunk of that is deposits of various sorts. So are there any variations, or are they just sort of like deposits? Is there any sort of variation in these things? Long-term and short-term? Yeah, and short-term ones, like, for example, we'll split this into two pieces. Short-term ones, like things like transaction accounts, are short-term. And what about long-term? What of an example of a long-term one in the deposit? Term deposits. Yeah, so there's a long-term one. Yeah, so term deposit. You probably should put a savings account in there as well. And so, these together, this tends to be what we consider our deposits to be. Now, remembering way back to I think it's our second topic. Remember the money supply, M1, M2s, M3s, and so on? Deposits and transactions costs, what are they? Are they M1 or M3? M1. That's because we talked about them being the transactional type money, and so that's money that's ready to go today for buying and selling stuff. What about term deposits and savings accounts? Are they M1 or M3? Yeah, they're M3. So remember that store of value type function of money? They're M3. And so when reserve banks are looking at things, those things have different functions within the economy. Okay, so where else can I get money to go about its business? Okay, so up the top here we'll put capital. Okay, so that's another place. So so in here you have share capital. So if they issue new shares, or this is money that was brought in when they floated the company, the share capital is certainly a source of funds that they use to go about the business. In the capital part, obviously once you had your initial dose of money, you want it to grow. How do you make it grow? If you want, yep. Don't hear noise? Oh, yes. Yeah, so as long as you're profitable, and we definitely want our banks to be profitable, you don't pay all your money out as dividends, you keep it in there. So retained earnings are there to grow that capital over time, and of course, if you keep those earnings in there, then you can grow the business by going out and borrowing more money. Any other source of capital that we should at least consider at this point? There is another one, the reserve accounts. A good example of a reserve account is if you make loans, okay, statistically, some of those will go bad on you. Okay, when you make the loans, you always try to make it in such a way as they don't, but over time, some of them go bad, and depends on economic conditions. Typically, in good conditions, even with good loan policies, around about 0.8% of the loans will actually default in some form. And what the reserve account does, in this particular type of reserve account, is essentially calculates, in a statistical sense, how much you expect to lose on that loan portfolio, and then that is provisioned there for losses, and that forms part of your capital. So basically, if, for example, the economy starts slowing down, you think your default rate's going up, or going to go up, you can grow that simply by increasing the size of your reserve account. Okay, so those are some of the, not the only bits of capital, but that's certainly another group of capital. Where else can we get money from to run our bank? Say we have more loan demand than our capital in our deposits is going to allow us to fund. Yeah? Borrow from other banks. That tends to be very small. It doesn't, I mean, they do that, but that tends to be very small. And the other thing about borrowing from other banks, it tends to be very short term. I could put that on there, but I think I'll leave it off. Any other ideas where they might get money from? Well, there's two other places they could get money from, and we'll just split this across here. There's money markets, and for example, a bank bill is a good example of a specific type of security that can be issued by a bank to raise money. Then there's also the long-term market. There's bonds. You can issue bonds. And although this group here, in one sense, all of this is borrowed, this group here is referred to as borrowed funds. Okay. Although the deposits, both transaction types and term deposits, are definitely money that they borrowed, when we talk about borrowed funds, it's this other stuff that we're talking about. Now, one thing about this is, and this is really about why banks can be a little bit fragile and this is inherent in the way they're structured. This group here, this deposit or transaction accounts, these can be withdrawn at will by anybody at any time. So you can take this money away whenever you want, but it forms quite a chunk of their source. And this is from this is actually last May's financial stability report from our Reserve Bank. And this is what it has to say about some of this stuff here. Okay, it says until recently, this CFR, this is the bank core funding ratio, okay, has been supported by deposit growth, outpacing lending growth. So people are depositing money in the banks and less people have been borrowing. Particularly as the majority of growth has been in deposits of less than 5 million. So that's kind of big for an individual, but that's small deposits. And they say, which are considered to be largely stable when calculating the core funding ratio. And the thing with that is, it makes an assumption that these ones here, which can be drawn out at any time by anybody for any reason, that they won't do that. That they would just simply leave that there, and that this stuff here, even though it's in one transaction type count, they assume that it's stable. So there you can see, well, we know that's actually not true because anybody can take it out at any time, but the assumption is, from the regulator's point of view and from the bank's point of view, is that that's stable, even though it may not be the case. And the other thing we can look at on this graph here, if you look at these ones here, this one here is the maturity and type of bank lending. This is the maturity one. This is the funding of the New Zealand banks, and this big blue chunk here is that stuff that has a maturity of less than 1 year. And if you think about all the loans they make, they're long-term loans, 25-year mortgages and so on. The vast majority is funded by stuff that's got a maturity typically well under a year. But the vast majority of the money is under a year. And then this little red bit is 1 to 3. The green bit, which you can barely see there, that's 5 years plus. And the bit at the top, which is black, which you probably can't see at all, that's the 3 to 5 year money. So most of the long-term money is very small compared to the short-term money. So this money, short-term deposits, bank bills, and all that sort of stuff, that's the majority of the funds being raised throughout these markets. And the long-term stuff, particularly term deposits of longer than 1 year, and bonds, again, longer than 1 year, you can see from this diagram here that they form a very trivial amount of the bank's funds. So that's one of the reasons why they are look pretty shaky sort of things. Okay, so let me see if probably one other aspect of this that we should look at is the cost. Again, if we split them into two pieces, I can change colors here. These ones here, these are low cost, and the money market tends to be relatively low cost because of the short term. And then these ones here, term deposits, your time deposits and your bond, they tend to be the high-cost funds, simply because the interest rates on these things are higher. So these are your low-cost funds. These are probably your lowest-cost funds. Typically, a transaction account has no interest at all. Some types do have small amounts of interest. You go to a time deposit or term deposit, interest rate goes up. Money market tends to be relatively low interest rates. Go into bonds, interest rate rises because of the higher risk and that sort of stuff. So there's differences in the cost of funds in these as well. Anything else we should say? Said most of that. Yep. Okay, any questions on that before we go on to, this is a little bit of a digression. Any questions on that before we move on? Yeah, go ahead.
So for this, just like you said, so for this transaction account, they're going to be on the issue date because it's quite liquid, so they can take it to the depositor can take out the money like any time. The issue that is supposed to be under the current liability on the balance sheet.
Yeah. When they're considering, when we go and look at the asset side, in terms of how much liquidity they have to hold against this stuff here, this is essentially a current one. I mean, a transaction deposit can be taken out any time, so it is current. Whereas something like a term deposit is non-current. So that one's definitely a current one.
So if it's a current account, which means for the banks, the working capital is quite big.
Well, it's working capital. Well, it's not really capital. It's money they borrowed. It's a liability. Because there's a difference between there's another difference here between another type of corporation and a bank, is that they have equity, and then they go and borrow more money, say they issue bonds, and both of those are considered, when you're doing the calculation, the cost of capital. Okay, and so if you want to raise money to raise your working capital, you say you might issue a bond to do that, and you bring in working capital. The way this is actually thought about, you tend to think about it in a slightly different way. So trying to say, push these into current accounts and working capital and so on is conceptually, conceptually you can do it, but it's probably best not to think of it in the same structure that you think of other corporations in. Does that help?
I think the only difference is that because they have to follow the Basel Code, so they have to put at least like what is that 8.5% for the capital against the debt. Would they have like a capital? Would the CEO or the director board decide the maximum capital structure? So they have to follow the rule.
Yeah, they have to follow the Basel Accord, but remember the capital is, when you calculate capital adequacy, it's actually against risk-weighted assets. And so it's not the capital to debt ratio they're looking at. It's capital to risk-weighted asset ratio. That's what they look at. So you're actually, instead of looking at one side of the balance sheet, capital to borrowings, you're looking at both sides of the balance sheet. You're looking at capital on one side and risk-weighted assets on the other side. That's the ratio that they look at. Okay? So you actually look at both sides of the balance sheet when you calculate your capital adequacy. Whereas for most companies, if you go to another type of company, what they calculate is the debt-to-equity ratio. And if you look at something like this, you got like 90% more plus debt of some sort. And so in a normal company, that's what you calculate, debt-to-equity ratio. Here, they look at both sides of the balance sheet, capital to risk-weighted assets. So it is, the way they look at it is actually different. I mean, still a balance sheet, but the way that they look at that balance sheet is different. Okay, any other questions? Right, okay, so moving along, this is a bit of a digression almost, but anyway, pricing deposits. What are the main factors the bank must consider when setting interest rate to offer on the deposits? What do they got to think about? when they go to the bank website and you look up an interest rate, say on a term deposit or on a particular account, what do they got to think about when they're setting that?
First, they need to consider the OCR, the official cash rate, OCR.
Oh, think about the OCR, where it is relative to the OCR. That's a good point. Hadn't thought of that one. Yes, okay, I'll take that. Yep, they got. So think about where this is relative to the OCR. Yeah, yeah. Go ahead.
Say like because the OCR is constant, like they still need to make a profit. So any like the higher the offer interest rate, the less profit they'll have. But at the same time, you mentioned that most of their funds that they use to buy loans are from the short-term deposits, so that you need to make sure that it's competitive enough that all the funds won't just go to another bank.
Okay, so one thing to have to consider is the competition. And the other thing that is the key point there is the stability of their deposits. Because like the thing I just showed you, the Reserve Bank and other regulators throughout the world assume that this deposit base is stable, and you have to manage your bank in such a way as to keep it stable, and often that means adjusting the interest rate so that people won't go somewhere else. So those are important things. Now, where's my other sheet? Here's my other. Well, this is probably a little bit, not quite relevant yet, but it'll become relevant later. This is the ANZ. This is from their, oops. Here we go. This is from their most recent public disclosure. It actually tells you what their interest income is and interest expense. And they had about a $1.5 billion income on the interest, and the interest expense was $798 million. So this is what they're paying out to attract the funds. And if we think about why they have to do that, they got to attract them in the first place. And then because of their type of banking business that they have and this assumption that they're stable, they have to hold on to those things. So there's an assumption that once you've got them, you're not going to lose this money. And so you have to manage your interest rate in such a way that it doesn't go away. Again, stable deposit base. That is very important, because if you lose your deposit base, very soon you're running out of your liquidity, and then you're in trouble as a bank. But on the other side, if you think about this gap, this gap here, you got your income from your loans and your expense. You really don't want that to get squeezed too hard. So you have to consider where your deposit rate is relative to your lending rates, and of course, the other view, where's your lending rate relative to your funding rate, is important as well. So the fact that there's competition out there, we end up with this situation where they actually get squeezed from both sides. So they sometimes get forced on the loan side to charge less than they would like, simply because of competition. And because of competition and this necessity to maintain a stable base, they often have to pay more than they would like, simply because they're in a competitive environment. Okay. Yeah, I think I actually said most of this when we were doing that. Where's my thing? Yeah, I think we said most of this. Let's see if we missed anything. So borrowed funds, that's this group down here. Yep, I think we said most of that, so that will move along. Okay, so here's a bit where we did miss something. Is that in this section here, if we make another little thing down the bottom here, or maybe stick it in here, repos are another source of funds. So if they engage in repo with another bank, that tends to be very short term and tends to be very liquid. So that's another source. Particularly, they use the repos, if they start to run low on liquidity, to very rapidly bring in new liquidity to replace liquidity which is being used up. What else did we miss? I think we said most of that. Okay. So any questions on this before we go to the bank capital? I think we actually did bank capital as well, didn't we? Said that. So that retained earnings. Yep, said that. Okay. Okay. So any questions on it to this point before we go to the other side of the balance sheet? Anyone want to ask a question, or are we going to the other side? Okay. So what we'll do now is we'll go to the other side of the balance sheet, and we'll start to look at what on earth are they going to do with all this money. I might keep it here. So we'll start with another box to put all this stuff in. And so on this side of the balance sheet, oops. These are our assets. Okay, and basically this is the uses of funds. So, like any other balance sheet, the assets have to be equal in size to the liability plus the capital. The only thing that you can have that's not that case is if your assets are less than your liabilities, in which case you are bankrupt. Hopefully we are, or insolvent, this case may be, but we certainly don't want our banks to get in that situation. So we're going to start off there and use of funds. So here's the basic diagram we had. We had this earlier. Talk about cash, investments, loans, and leases, and other assets. So what would you have on your balance sheet that would be considered to be cash? So we'll put cash up the top here. What sort of things would you have on your balance sheet that would be considered to be cash items? Oh, notes and coins. Yeah, notes and coins. That's definitely one of them. Yeah, and you know, when you think of the economy, like in Australia, it's probably, I can't remember off the top of my head, but I thought it was like $40 or $50 billion in notes and coins. And so, you know, those ATM machines and the bank tellers, the banks and their vaults, there's notes and coins in there, and that would be count as cash assets. Anything else that they would have that would be considered cash? Actually, that actually goes on the liability side. Okay, so if you have like you've issued a security and you've taken a loan, that goes on your liability side of your balance sheet. So a money market security that you have issued is not on your asset side. Okay, so it's actually a reverse repo. So if you've engaged in a reverse repo, then that is considered to be, reverse repo. That's considered to be a cash asset. Anything else in particular that we might put in the cash asset side?
Sometimes the bank overdraw from the corporate.
Banks overdrawn from the corporate. Hang on. Oh, I see. Okay. Yeah, I think as a group, that's called cash items in the process of collection. Yeah. Did you have another one?
The ESA account?
Yeah. So basically, account at at your reserve bank, the ESA accounts. So as a group, if you think of two things about them, one is this is really liquid stuff. And so, if someone's going to make a withdrawal, it usually comes out of here somewhere. And the other thing about it is that it doesn't earn much, and typically it's anywhere from 0% up to maybe about the OCR. And so, very liquid, but low return. So why do you have these? Why do you have these things on your balance sheet? When you think about it, you can make more money somewhere else in your balance sheet, move them off into loans, but why do you have it? Yeah? Yeah, it's particularly transaction accounts because this is, you need liquidity as a bank to function. This is where your liquidity tends to come from. And so they hold, in one sense, there's an incentive to hold as little as you can in practice because you don't earn much, but then you can't hold too little because you need it to meet your liquidity needs, and if you can't meet your liquidity needs, you are out of business. Okay, so let's move along. So there's the things, so we have default cash reserves at RMB and Z, yep. The bank's unsold, that's reverse repos and stuff. And there's our needs. Okay, so let's go to a second group, and we'll make another group in here. And these are our investments in here. What type of assets that you may have as a bank that would be considered to be an investment? And again, it's sort of a technical term because most of these things are investments in one way or another. Government bond, yeah. Government bond would be considered to be investment, so shove them in there. Anything else that would be considered an investment? Corporate bonds, yeah. So I'll split that into two pieces. I'll put the corporate bonds in a slightly different box, even though it's in the same box. So corporate bonds, and so that's your investments. Now, why would you hold these things as a bank? Why would you hold them? Let's take them in two pieces because they're actually, I'm going to put a dotted line through. Why would you hold government bonds? Why would you hold government bonds on your balance sheet? Risk-free, yeah. Okay, so they're very low risk assets to hold. Anything else about them that would be good? Okay, so particularly using in the repo, and so what this gives you, although a government bond is not liquid, it can very quickly be turned into liquidity, and so this type of investment is often considered to be secondary liquidity. So this money is ready to go now, up here in the liquidity. Something like government bond, you can trade it on the repo market. It's an approved instrument to trade with the central bank. Very quickly, you can turn that into liquidity if you need to. It's not liquid now, but if you need liquidity, and liquidity is running down, this stuff can be turned into liquidity, and so it's considered to be a secondary type of liquidity. When you're thinking of returns, would you earn much on this stuff? Not much. I can see somebody shaking their head. No, you don't. But you earn typically you earn more than OCR, and so you may not be holding enough in here to meet all of your liquidity needs. But as long as you have enough in here that you can quickly get the liquidity you need, you can actually earn a little bit more. So as a bank, you're trying to make good profits while also making sure you got liquidity so you don't go out of business. These types of things tend to pay you above the OCR. So you get a better return there as well. Okay, any questions on that before we... Yeah, go ahead. The corporate bond is... Probably the best way to think of this is money I haven't found a good use for as a bank. And so corporate bonds you would hold in the case that you've made all the loans and leases that you need to make, and you've still got more money, and so you go and invest in a corporate bond until such time as you need it for a loan. And so that tends to be money that is sitting there looking for a better home. Okay, any other questions? Okay. So when we go up to the next, let's see if we said, there is this issue around diversification, okay? So particularly when you're starting to hold things like corporate bonds in your portfolio, it does give you a little bit of benefit of diversification away from an all loan or portfolio that you have. But typically, if you do that, you go for a corporate bond, you could earn a better return on something like a loan, but corporate bond is significantly more liquid, and of course, because of that more liquid, you get a lower return on it. So the next group here, the loans and leases. And typically, this is the biggest piece. On a typical balance sheet, this is usually about 2/3 of assets. So why do we have these things? Why do we have loans and leases as a bank? And this is like our biggest part of our business.
That's where the profit margin from.
Yeah. So highest return. This is where you make your money. So this, in terms of return, this group here, the loans and leases, they are the highest return. But on the liquidity side, very illiquid. So return doesn't come for free. It comes because you've taken a well thought out, wise risk. You haven't gone out and recklessly invested. You've thought about the risks you've taken, you evaluate them, and you've charged appropriate risk premium. But overall, this is where the bank makes most of its money, in this area here. Okay, what about the last piece? Oh, maybe see if I say anything else. Need to say anything about them. Said that. Yeah, again, things to look at in terms of the loans is whether secured or not. What the quality of collateral, that goes into your decision on the interest rate that you charge. And this is a range of stuff that you may see in there. Bridging loans for transactions, seasonal loans, say to farmers, to get them through the growing season, mortgages and so on. They're all loans of various sorts. So there's another great list of them. And pretty much most banks in New Zealand would have all these types on their balance sheet. In fact, the latest, I didn't bring it, but the latest financial stability report from the Reserve Bank said about 10% of banks' loans are actually to the dairy sector, which is quite high. So, loans to farmers in New Zealand, about 10% of total loans actually are to the dairy sector. Maybe we should. You don't see this a great deal in New Zealand, but lease financing as part of a bank's business is certainly growing overseas. Why would they do this? If you think about what's happening, the bank buys whatever this asset is, and then it leases it to a customer. And basically, they buy the asset at the request of the customer and then lease it to them. What's the advantage of doing that? Why don't the customer just get a loan and go buy it?
So you have an asset that if the customer in default, you lose that.
Okay, so there's one of the key points. In a default, okay, let's say, for example, Air New Zealand says, can you buy me a nice 777 airplane so I can go fly it, please? And you say, sure, we'll go buy it. We'll lease it to you. In a default, the bank is the legal owner. Typically, recovering money in that situation is much easier than if it was a loan. And that's one of there are two key advantages, and that's one of them. In a default, recovery is significantly easier than if they did it as a loan. So what's the other one? There is one other key advantage to doing this. Yeah, go ahead. Would your airplane become more valuable as time went on? A house. Yeah, in some types of assets that's the case. In general, most types of assets that are subject to leases, that's not the case. I mean, you certainly could, if they bought a commercial building, that would increase in value over time, and they would hold that. So that's not considered to be one of the major advantages. The major advantage of this is in the taxation. So what tends to occur is you have one party on the top tax rate, and the other party that wants to lease the stuff from you is in a lower tax rate. The fact that they're on a lower tax rate means that if they bought it themselves, okay, they have to pay for it, and then they would claim depreciation. Because they're on the lower tax rate, that's not a big advantage to them. If they lease it, full lease costs are tax deductible. And so the tax differential between the person who, well, corporation who buys the item and then leases it to the user, if there's a good big tax differential there, then leasing becomes worthwhile. If there's no tax differential, then leasing is not worth it, typically. That's one of the big drivers there. It can be much more economic to actually to lease rather than to buy in these cases. Right. Okay, so basically run out of time. So we've got a little bit more to do down here, but we'll start at this point with the loan pricing on Monday. Now, I've got another meeting which started at 11:30, so I can't stay around today. But if you want to walk with me and you want to ask questions and walk where I'm going, that's fine. I'll talk to you as we go.